Great. Hi, everyone. My name is Mike Paulenoff. I'm the editor and chief cook and bottle washer, as it were, of TradeOutLoud.com. And what you're looking at is the front page of my website. And I'll just give you a thumbnail. That would be me right here. And what you see is Mike's top call every week. On the weekend, I put out a top call and it reviews something that we did during the week, and it has chart work and an explanation of what it all means. And so every week that goes out free to all the subscribers or all the people on our mailing list and people like yourselves who signed up for some of these webinars and seminars. The website itself in the room, let me just go down and give you a real quick thumbnail sketch of what like today looked like for us. Okay, so here was my first at 8 o'clock this morning Eastern time. Here was my first update, and I did what I call out front, and it goes out to everyone by email at 8 o'clock. And I entitled it From Retail to Online Advertiser Market Carnage. And of course, we all know what happened to Snap and how it affected Facebook, Google, Amazon. And I review my chart overlay on the impact of Snap earnings. So you can click on the chart and it opens up broader. And I went through each one, Facebook, and it's 8 o'clock in the morning, and I gave my perception based on my chart work on what the price behavior. I am a behaviorist and a price behaviorist, and what prices would do or might do based on my chart work and my pattern work. So anyway, that was first, and then I typically every morning use the S&P futures to get bearings on direction for the day. And here's my 15-minute version of the S&P June mini, EE mini, and my chart work and my measurements and my my directional dotted lines. But in any case, it gives you a pretty good idea of the risk reward parameters set up for the day in visual form. Now, I'm the type of person that I get into the visual interpretation of price action and pattern work, and I find it helps, and subscribers appreciate when my description of the psychology of a market overlays on my chart work of a market, which then overlays on fundamentals. Now, I don't do fundamental work. I read and I use analysts from Seeking Alpha and so forth and so on, and other services to get a grip on what I think the fundamentals are, number one. Number two is I fit the fundamentals to my technical outlook. So when I first started on Wall Street in the early 1980s as a commodity analyst at Smith Barney in New York City, I was introduced to technicals, and I thought the technicals were ahead of the fundamentals. And sure enough, at the age of 24, that was a pretty interesting perception, because I think it's true, and it's a universal truth that the technicals lead the fundamentals. So I did things backwards and on Wall Street, and I was always criticized because, of course, us technicians on Wall Street were ostracized, quarantined, and blackballed, and put in a corner of the office space in the building, because no one wanted to admit that there were technicians that actually could figure out where prices or price trends would go. But anyway, so to continue, so on this site this morning, so I do all sorts of things, and I put up comic relief and from the left and the right, political perspectives, and then I'll put up articles that I think are interesting and comment about these articles. in this one about BlackRock, my comment was, I have to say that it's shocking to see that a big shot manager at a shop that runs trillions of dollars admits that he is dependent on Jay Powell's Fed to reverse course on its hawkish inflation-fighting commitment as a condition for his participation on the long side of the equity markets. Well, what do you know? So that just proved the point that all these years, while everyone was saying, yeah, it's the Fed, it's the Fed, and the Fed, and the Wall Street people would say, no, we really think we know what's going on. It has nothing to do with the Fed. These companies really are what they're worth. Well, we're finding out very soon, almost day by day, minute by minute now, that these companies aren't worth what they thought they were worth on Wall Street. They were worth what the inflated Fed made them worth. Okay, that's the end of that diatribe from me. Anyway, I did a thing on natural gas. Someone brought it up in the room. One of these other people you hear, I'm MJP, and anyone else is our subscribers who put their opinions up, their ideas up, and we discuss them. And someone put up that natural gas looks like $9.50, and I went in and I did the natural gas perspective from what I thought an equity component looks like, and how would it behave if nat gas actually did explode. And so I use Southwest Natural Gas, Southwestern Energy, that is, and this is a weekly chart that goes back, I don't know, 10 years, no, 5 years. Well, it's 2016, and this chart looks unbelievable. And it is a natural, it is a natural gas producer, and it will benefit from natural gas. If natural gas goes from 4 to 9 to 12 or whatever, and we're just starting hurricane season now. So on, and all through the day, we're doing updates, we're discussing things, and wherever people take me, I go, and then I go in my own direction a lot of the time. And then people ask me and then they fill in behind in terms of what I'm doing. And so that is a thumbnail of mptrader.com, and feel free to join us. I think there's a 2-week free trial. And you can get an idea of what we there it is. So these are every chart analysis I put up, I put into the coverage list. And today I did a big workup on silver, and during the day, and SLV, and I did the gold silver ratio, and then I did copper silver ratio to show that silver's getting cheap vis-a-vis copper. And of course, you can't talk about silver and gold without talking about the dollar. And the dollar looks like it put in a 20-year high. So that certainly should pique a lot of people's interest, because if the dollar has put in a V top, as it were, then it opens up all sorts of interesting things for the commodity markets that have already broken out, a lot of them, but this just adds tailwinds. Okay, so those of you who tuned in, thinking that, or seeing the title to my presentation, which I'll quote, Reorienting Investor and Trader Mindset from Bear to Bull Market Psychology. Okay, so you're probably saying, nah, this guy Mike is going to try to tell me we're in a bear market. No, I'm not going to try to tell you anything. I'm going to try to show you and lead you using breadcrumbs to the conclusion that somehow, and most definitely in my mind, after the January high in the stock indexes, in the equity indexes, something has definitely changed. And I think most of it is a result of the Fed putting their liquidity machine into reverse. Now, that reversal in liquidity has just started, or maybe maybe some of you think it hasn't really even started. But hang on, let me just go over to my chart work. And, but I beg to differ. I think that things have changed. And so let's do a little scan of what's going on. So this chart is the cash S&P daily. It goes back, what I have on the screen right now, it goes back to just before the pandemic low of 2020. There it is right there. And that was at 2191, 2192 in the S&P. And the crash, as it were, from the pre-pandemic high looks kind of minimal on this chart. But this was 33.93 in February of 20. And here was the low. And that was a significant decline until the Fed pumped in $5 trillion in about 2 weeks. And one way I look at this chart, forgetting all the hieroglyphics on it and my cycle work and all that, which I'll explain in a second, you had a massive uptrend. And the way I look at it is that from all the way back here at the pandemic low to the January 2022 high, I look at it as it took that long for the money, the $5 trillion, to work itself through the system, just like it took 10 years for the original QE to work itself through the system into like 2018, 2019, 2020. Let me just go over here, and I just want to back up for a second because I want to show you something, getting more adept with this. So here's Ed Yardeni's chart in his site, Reorienting Research, and what you're looking at is the Fed, the S&P, and the Fed balance sheet on the same chart, overlaid with various shades of QE. Okay, QE1, 2008-9, QE2, 3, quantitative tightening they tried. Remember back in 17 with Bernanke, and everyone freaked out. The bond market freaked out. But the red line is the S&P, and the blue line is the Fed balance sheet that, you know, is like $9 trillion now. And at the beginning of QE, it was 900 million. So, well, is that right? Maybe I have too few zeros. Maybe it was 900 billion. And now it's 9 trillion. Anyway, the point is that the red and the blue lines look very, very conspicuous in that they track each other. What is interesting is now the red line has rolled over, being the S&P, and the blue line is cresting. The question is, we get together a year from now, what will that blue line look like? Will it have bent over and mimic more than any little tick down that we've seen since 2008? And will it resemble a top? And in order for that to happen, the Fed's going to have to hit the reverse button big time and really go through with their quantitative tightening. Where will this red line be if that happens? I don't know, but I don't think it's going to be going north. So let's just put that in the back of our minds for a minute. All right, so let me go back to my chart work. Whoops. So the Fed is where it's all at. And I realize that many people, and there's part of my mind that thinks the same thing, that we're all being told that the Fed can't afford to raise rates to 5% on the short end. I mean, they're at 75 basis points now, and everybody's freaking out that the economy is going into a recession, and that the Fed needs to already put out smoke signals that it is not going to follow through. Now Powell did that in 2018, which was 2018. Well, I got to back up. So here was 2018 right here. And I'll blow that up for you because, so here was 2018 right here when Powell started to say that in 2019, he planned to hike 4 times. And the market went down and he panicked, and that's history right there. So anyway, will history repeat itself this time? I don't know. I doubt it, because, come on. All right. Come on, come back, come back. Come back. So I doubt it this time. I think Powell is going through with it because he has no choice. Now, this chart, just before I leave this chart. So over the years, I do cycle work, and my cycle work isn't any esoteric cycle work. It's eyeballing and observing when markets kind of make lows and when they crest and when they roll over, and is there a cadence, plain and simple. And the cadences I've found going all the way back to the great financial crisis, 2008, is there was 100 to 120 day trading day cycle. Then it morphed into a 140 to 150 day cycle, and it'll probably morph again, but I keep an eye on it. And it just so happens that the October low of last year, it is on the low last Friday, what could have been a capitulation low last Friday. It was on the 20th, and it was day number 156 of 140 to 150 day cycle, plus or minus like 10 days for overshoot or undershoot. So we're in a window now where I think we can expect a cycle low. That doesn't guarantee one. It just tells me to tell my subscribers, you, that this is one indicator, just one in a grab bag of, indicators that I follow and that we watch, that could be telling us that the market is sold out and that we should be looking for a cycle low, meaning a big upside reversal day. We haven't had it yet, but we may be making a cycle bottom rather than a cycle low, in which case we'll have a cluster of days and then we'll take off, and there'll be one obvious day like this where in the time frame where the cycle is supposed to be bottoming, that it does. Okay, that's done. Okay, so let's go back to the thesis that something's changed. And I think for the most part, I have to go to, I can't widen that chart because it doesn't take up the whole screen. This is, believe it or not, this chart goes all the way back to like 1986, maybe even goes back further. Yeah, it goes back further to 1984 when 10-year yield was 15%. And believe it or not, that's when I started my career. And I started my career at the highest interest rates and the highest inflation that we've had in 40 years. So I've waited. In fact, I told you that I started my career at Smith Barney as a commodity analyst. Well, Wall Street was hiring like crazy. Commodity analysts, because that's where the action was. Well, that lasted about 12 months, and then I needed a career change, or I needed to figure out what was happening. And so fortunately, I thought maybe I turned out to be a quick study, because I said, holy cow, I got to get myself into foreign exchange or some other market discipline besides commodities, because they were coming down. Volcker was making sure that, and Volcker, this was all about Volcker up here. And what he did created really a deflationary impulses for 40 years. So here we are. Okay, so from about 2012, for 10 years on this chart, where I have the half cycle, is basically the bottoming period for 10-year yield. So 10-year yield these are extraordinary numbers. 1.4% in July of 12, 1.3% in the 16. And then we went down to 0.4% in 2020. Well, since that low in March of 2020, 10-year yield has moved straight up, and it has taken out the trend line from 1990. Now, I don't know where you were in 1990, but that was 32 years ago. Any market that takes out a 32-year trend line gets my respect. And another thing, the fact that it took it out and has held above it suggests to me also that this is the real McCoy, that this market has bottomed. And it hasn't bottomed this isn't just a V from here to there. This is 10 years of bottoming. Now, if this were Apple, you would say, holy cow, I gotta get myself some Apple. If it was soybeans, you'd say, holy cow, I better buy all the protein shakes I can buy now. But it's not. This is interest rates. So what do we say about that? Oh my God, we better protect ourselves against this thing breaking out. You can see my dotted line suggests that over time, I don't know if it's going to be in 3 months or in 3 years, but over time, it looks like we're going to 5% and then close to 7%. And here we are trying to break out above 3.25. I don't know what the world's going to look like. But if it's inflationary, and there are only two things in my mind that can create a breakout like that. And that is inflation, and the Fed maybe makes a policy mistake. Maybe Powell backs away, and then incipient inflation through the energy markets, which we're going to get through in a minute. Maybe incipient inflation just is stubborn. This chart is telling me something is going to be really stubborn because rates are going to stay up. So on one hand, there are two things that could get it to go up and keep it up. Inflation that doesn't respond, or a US dollar that unwinds to the downside. For whatever reason, the world decides it doesn't want dollars. And here is the other side of this. I had a better chart of that. Let me get rid of that and go to this chart. Well, there's oil. Hang on. Let me get my dollar chart. By the way, I'm using TradeStation, which you can see I've used for a lot of years because I have a lot of hieroglyphics on these charts. But I like TradeStation a lot. And come on, there we go. All right. Where is the dollar index? Weekly dollar. Okay. So just to continue the thought, and then we'll get back to the energy markets. All right, here's the dollar. So this chart goes back to 10 years. And as I see it, over the period, say 2015 to now, 7 years, we've had basically a range-bound market in dollar index, right? 100 to 103, let's say, on the high side versus, let's say, 92 to 88 on the low side. And we've spent the last, what year is this actually? Yeah, the last year going from one side of the range to the other. And last week, the dollar index broke out above this massive resistance zone. And instead of continuing higher, it bull trapped everyone, or bull trapped the bulls, so to speak, and reversed. Now, the question is, where is this going? I don't know. But if every time it's been up here, dollar index, in the last 10 years is any gauge, then this reversal means something. And we are about to embark on a year or so traverse of this entire range. And if that's the case, then we're going from 105 to, let's say, 90. And that is 14, 15% move. Now you get a 14 to 15% down move in the dollar, creating tailwinds under the commodity markets. And this chart takes on a little bit more meaning, doesn't it? To me, it does. That gives, in the past, just remember, going from right to left on this chart, the dollar was not cooperating for most of that time. Now the dollar is about to roll over, or might be in the process of rolling over, and it's creating tailwinds for higher interest rates because it's going to motivate markets, in particular the commodity markets, higher. Now, the commodity markets are an interesting story. Oil, of course, we all know about oil. Let me go over to oil, and let me get rid of this and go over to my long-term oil chart. Okay, so it's nearest crude. This goes back to 2003 to present. And we know what happened in July of 2008. And we had that massive bear market, culminated in some contracts at, under $10. Some contracts went negative. That was a crazy time in the market in the spring of 2020. But from wherever we decide, $0 per barrel to $650 per barrel, we have since gone to 125, 130. And it doesn't look done yet to me. Now, yes, we've come down. This is sort of a strange weekly chart, the way it spikes, because it's nearby. Whoops. So let me go to a daily chart, and just to finish the thought. Okay, here's nearby crude. Come on. Whoops. All right, so nearby crude has gone from $52 last August to as high as 126 roughly, has been consolidating at a high level of pretty much above 100 for 2 months, 2.5 months, and looks like it's about to thrust out of this, trading range. If it gets above 112, 113, I'm thinking it's going to 130, or it's going to challenge this high and make new highs. Now, there's a cluster of MAs here. My 10, 17, and the 50 is not far behind, but it's curling up. So when you get a cluster of these moving averages like converged, and then the price structure sits on top of them, usually it's a precursor to a strong directional move. And with the price structure sitting above the MAs, the direction usually is up. And there's not a hell of a lot, not a heck of a lot of room between crude, where it's trading at this moment, 110.56, to 113, 112, 113. So if it thrusts, technically, there's going to be some combustion here on the upside. So that's crude oil. And the crude oil weekly and the crude oil daily are pretty much both telling me the same thing, that crude is not done yet. And in terms of time, it went from 2008, you went down really for 12 years. You had a bear market in crude. And so far, we are in our second year of a bull market for crude at the tail end of that. And ironically, with all of the emphasis on green this, green that, electric this, electric that, the emphasis from this administration on not providing supply for crude oil to bring down the price of gasoline is feeding into prolonging this cycle and upcycle in crude, because supply is just not there. So, and demand, unless Powell kills this economy, but good, demand is going to stay relatively high. And even if it comes down some, the question is the supply there? We don't know. I mean, there are all these geopolitical problems, and oil has been used as a weapon in the past. And we're not willing to open up our own lands for drilling. So who knows what the supply demand of oil really is or will be, even if we have a growth scare or worse in this country. Could it be as a hypothesis that oil stays stubbornly high, demand for oil comes down, but the supply can't meet the demand anyway? Well, I don't know. That old adage is high prices. There's no better cure for high prices than higher prices. Well, gasoline is going to tell us that pretty soon. And I don't know whether it's going to $8 a gallon first or 10. I don't know what the elasticity of demand is or in this country for gasoline, because, you know, we're not all going to be riding public transportation, and we're not all going to be riding bikes. So let's see what happens. Anyway, so we have the bond market, that is yield moving up. We have oil going through the pipeline, as it were, into other goods and services. The perception that the housing market is flying, but maybe softening now, but has been flying. We have a perception now that we didn't have for the last 15 years. I won't buy it now, because chances are in 2 months, the computer will be cheaper, technology will be cheaper, cars will be cheaper, anything that has computers in it will be cheaper. Well, that perception has flipped on its head, and now we are thinking that houses are going to be more expensive, cars, because you can't get them. Anything we buy, we're accepting the fact that we're going to pay higher prices for it. And that is really where Powell has to be so careful, because once we're convinced that we can raise prices as businesses because we as consumers are getting accustomed to paying up, it will really be very difficult for Powell to change that perception, especially since that perception was moving in the opposite direction for 30 years. So it may be that the economy goes into a growth scare and a slowdown, but we as psychological animals don't see it that way. We're expecting to pay higher prices anyway. And that takes us to that crazy time in the 1970s during the Carter administration that we were fondly referred to as stagflation. And well, I think there's a pretty good chance that if, lots of people do all sorts of overlays and anagrams on past periods in U.S. history, well, if I had to, I would say this is the 1970s starting all over again in many ways. But anyway, let's continue, because I have a couple of other. Let's go back to the commodity page. This, by the way, is if we wanted to transcend gold to a physical gold, equity-based product. One of them that I follow on a long-term basis is the Sprott Physical Gold and Silver Fund. And it's out of Canada, and you just be careful about the tax consequences before you dive into this, because you need to check that out. But this chart goes back to 2010. And I don't know about you, but this is one heck of an accumulation period, and followed by an up move, followed by a high level digestion period. And well, I'm thinking that this is a bull flag after a flagpole, and as long as, say, the 200-week moving average or the $16.80, $17 level is not broken and sustained on a weekly basis as a weekly chart, that CEF is looking higher, and it will be a version of inflation and gold because it is a spot gold and silver vehicle. So anyway, I throw that in there because this looks like oil, and it inversely related to the dollar, which may be peaking after hitting 3 highs above 103 in the last 10 years, on and on. All right, there's your dollar index again. I want to go to agriculture for a second, which I'll use the DBC and the DBA ETFs to illustrate my point, which you can also, participate in because they trade as equities. They're ETFs. Let's do DBA for agriculture first, and just in the back of your mind, just keep the CEF and the crude oil long-term chart in your mind. Well, this goes back to 2013, 10 years. And this is the agricultural ETF. And it looks like it had a really big bear phase. This is 2012. So this is, 2020, 8-year bear market. And this looks like it's about to take out the next serious resistance level and keep going. And this is a reflection of wheat, corn, soybeans, soybean meal, soybean oil, on and on, some softs in there. So all we need, or I should say, all that has to happen in a trend like this, and it's interesting how the news perpetuates the trend. When the trend is bearish, you get bumper crops like you never saw before. When the news is bullish, all of a sudden there's too much rain, the crop is ruined, there's too much heat, they're fried, who knows? So somewhere in this mix of corn, wheat, soybeans, this chart is telling me something will probably happen in the real world. The corn crop's fried, or there's too much rain, not enough rain, it's delayed, there's not enough plantings, there's not enough acreage, who the heck knows? But this chart is telling me that whatever the surprises are, there'll be bullish ones. And, the economy might be slowing down, but the price of food looks like it's going to create havoc anyway, that people are going to have to pay up. And the processors, for cornflakes and whatever else people, bread, people are going to be paying up because those processors and in the end manufacturers think they can raise the price. And we're expecting to pay higher prices. So there you go. At least that's my perception of what the world looks like at the moment. All right, let me go over now and go to DBC, which the C is a mix of metals, industrial metals also. And so, all right, so this chart is a beauty also. And so it's telling us that, we had a big bear market, 2008. There's oil in here because that's too much of a coincidence. So there's oil and metals and grains and industrial metals in here. And it looks like big accumulation, 2015-16 to 2020 breakout, hitting resistance here. It's going to probably go sideways maybe for a few weeks to a couple of months, and then it'll break out again, I think, and go higher. It just has that look to it that this is kind of like a secular change. This was a secular bear market. We've transcended into a secular bull market. We could say the same thing about this secular bear market, years of change, breaking out into a secular bull. Seems to me that's the story. Then you have this chart, and this chart looks just the opposite. This looks like a big rounded distribution top. The bond market or the yield chart looks like an accumulation breakout. This looks like a rounded top breakdown. Now, okay, so you say, well, but we've come down 20%, and sentiment is cooked, or so we think. Let me share that with you. Sentiment is cooked. Let's hold that thought, and let's go over to fear and greed, just to pick an indicator. All right. So here we have extreme fear. I mean, doesn't get any, like, I think I saw it at 8 or 9 last week when we were, last Friday. But even so, you don't get too much more fearful than this. And fear can be translated into I'm too afraid to buy anything, or I've dumped everything, I'm in cash. That kind of fear. A week ago was 15, a month ago was 32, and a year ago it was 29. So this index where this gauge is telling me that chances are, if everybody is out or everybody is too afraid to buy, that's pretty close to blood in the street. And maybe it is time to step up. All right, let's step up. All right, let's go back to, let's go back here, and let's go to, no, I'm sorry about that. Let me go to my short-term work, which you saw on my front page. Where is my futures? Okay. So I just want to point out something about sentiment. And if I overlay it on one of my shorter term charts of E-mini S&P, I just want to show you something that I find really curious. All right. So the S&P is up after the close. What do you know? Here you go. You're making, it's 39.60. Okay, we're getting there. Okay, but anyway, for illustration purposes, here's where it was 9 last Friday. I'm talking about the fear and greed index. Now it's 12. Well, on one hand, it's staying low. So that tells me there's still so much fear that we have an explosive advance coming. Maybe we do. On the other hand, could we translate the fear and greed index as, maybe because we are in a different paradigm now, because this is the dominant picture now, maybe, just maybe, fear is going to stay in abnormally, quote unquote, abnormally low levels. That is, everyone's going to stay afraid for quite a long time because we're in a distribution market and the paradigm has changed from bullish to bearish because the Fed is reducing its liquidity direction from in to the system to out of the system. I don't know, but I know one thing is that my indicators in 2012, 10, 11, 12, 13, the indicators that worked before that about telling me about sentiment, and about technical analysis and about what markets should be doing all changed because of the Fed. They all didn't work. None of them worked. None of the overbought indicators worked while the Fed was pumping money in. So I'm thinking maybe the inverse is true too. As long as Powell and QT is on the front burner, my indicators will tell me the opposite. First of all, they'll start to work the way they used to pre-great financial crisis for the most part. And my oversold indicators will be stuck in oversold, and very fearful for much longer than we think. And that doesn't mean that the market's going to go up more. It's going to be that rallies don't register as they once did because we're in a bear market psychology. That's one thesis I have going forward. And I want to see, like, I think that this rally could get through 4,100, maybe even get to 4,300. So on a big picture scale, what does that mean? So the 50-day MA right now is at 4,300. So let's say, for argument's sake, we get to 4,300, which would be a huge rally from 3,800. And at that point, I don't know what the fear gauge is going to be, but I guarantee you my indicators are going to be overbought and screaming that this market is cooked for a while. So we'll see. My sense is that this crown top is very meaningful, and it won't end anytime soon, even though there will be great rallies to take advantage of in certain stocks, right? And we've all identified them. Like, for instance, let's go over to energy, and let's take, well, of course, energy might be a crummy example because the energy stocks in this sector is the one sector that's been up all year, unlike anything else. But there are a couple of names in here. Let's just look at them real quick, just for kicks. All right, we did the natural gas one, Southwest Energy, but let's look at PSX, which is interesting to me. This is Phillips 66, and this is one of my catch-up names, not in Heinz ketchup, but in catch-up to Exxon and Oxy, and where Buffett is. Okay, so let's just look at Phillips here. So Phillips, well, let me elongate it. So Phillips has been lagging behind because if you looked at Exxon's up here, Oxy's up here, Hess is up here, Devon's up there, but not Phillips. Phillips looks like it's spent the whole time that these other names, companies were rallying. It was accumulating, and now it's just starting to break out. And my theory here is that Phillips is about to play catch up in one major way, and it's going to end up somewhere up here, 115. And right now it's 96.77. For me, the way I would describe it, or I'm describing it to our members, is that let's keep an eye on the trailing 50-day MA. If it breaks and closes below that, all bets are off and we have to reevaluate it. But for now, it looks like it's poised to take off as an example of a name that in this market you can hold. Now, unlike names that you can hold, like in energy, there are names that you can't hold anymore, but you can rent. Like, in fact, I'd say 80% or 90% of the market is for rent. And that is, by rent, I mean, big tech. All right. So for rent, I mean, you know, it gets to a point where you think it's either ridiculously cheap because your fundamentals and your metrics, PE and valuations and whatever you use is telling you that it's gone from a 26 to a 12 and PE, and that it's crazy. You got to buy it. Or you overlay the technicals on it and you say, you know, this thing is worth renting for a little while. So a lot of the, as this loads, you'll see a lot of the FANG stocks coming up. And of course, they've had their trials and tribulations. And if it loads, oh my God, I only have 7 minutes left. Okay, well, anyway, we're going to pick one. I'm going to do that. And I'll leave you with some closing thoughts. Come on. All right, whichever one I'm left with is the one I'm going to go with. Okay, this is Facebook.
Hey, we're just seeing like an error message. Open workspaces, something opening.
Well, I'm showing your screen sharing is paused. What do I do?
Oh,
new share.
Yeah, you might want to just here. I'll stop it for you.
Oh wait.
And then if you share again.
Okay, thanks. I'll share it again here. Let's see. It still says. All right, I'm going to stop share. Okay, so I stopped share, so I hit share screen again.
Yeah. Yeah.
Okay. So this, and then this. I don't know. I still get resume share. Let's try that. Come on. Well, come on, resume share. So what are you seeing? Nothing?
It just says it's loading, basically.
Oh.
Started.
That's weird.
Screen sharing. And what are you seeing?
I'm seeing my chart of Facebook with a yellow error message up top says your screen sharing is paused.
Okay. If you click on the Zoom menu, do you see anything about resume sharing or?
Come on. Meeting controls. Come on. That's terrible. All right. Stop share. Mike. Okay. And I'm going to share screen again. Let's see if this works this time. Oh. Resume share. New share. All right. One more time.
That's weird. I've never had anyone have problems like this before.
It's crazy. It keeps giving me a yellow. Your screen sharing is paused, like it doesn't want to. All right. Well, I'm 5 minutes out, so I'll leave everyone, since they can hear me, with the following thoughts. So there are lots of tail risks, and I think that what we looked at tonight is inflation embedding itself via energy and some other in the bond market that is yield vis-a-vis a topping distribution period in the equity markets. And the tail risks are more than I've ever contemplated as a market participant in my career. That is, there are so many at once. And so, like, uncertainty is the catch-all for whatever you're in. And it's almost like what could go wrong or what can go wrong seems to go wrong. Like every day, I don't know about you, but I wake up or in the middle of the night when I crazily grab my iPhone and see what the markets are doing. There's always something that says, I cannot believe that. It's either a market or a policy or an event. And these are becoming like the tail risks. I mean, the definition of tail risks, I guess, is like some rare event that's like 2 or 3 standard deviations from the norm. And there are so many of those that are possible. Like we know World War III is possible, but it's a tail risk for the markets. Russia versus NATO, Taiwan, nuclear confrontation, geopolitical uncertainty and tension just in general is a tail risk. Recession now is a growth scare or something worse. That's even a tail risk, I think. 1970s style inflation, which no one thinks is possible and no one thinks is likely, is a tail risk. It's kind of like 1970s on steroids, if you believe it or not, because, you know, when the Fed pumps a decade's worth of or $5 trillion into the markets in 2 years, that's in the system for a while. And I don't know how they're going to mop that up. Now, maybe the stock market has to mop it up for them. And we go down 50% or 80% or some crazy number, God forbid. And everyone realizes that the market has just destroyed a whole lot of wealth. Well, maybe in the history books, we'll look back and say that wealth was phony wealth anyway. It wasn't organic growth in business or company growth. It was Fed growth. It was companies buying back their own stock. It was phony. Well, anyway, you get the idea. So there's lots of stuff out there. Anyway, we discuss all this stuff on MP Trader, and I hope that I've piqued your interest in certain things. So come over and join us and take a trial and join the conversation. And I really appreciate the opportunity